All right, we're recording middle summer, but it doesn't matter when we're talking about this. If you're watching this on recording, some of these updates I'm going to give you in the first 5 minutes might not be relevant, but the rest of this session will be. And I'll tell you why we're going to cover this today. Couple things that are important. Thursday, look for an email for a session on some updates with these edge zones and what people who have edge zones have to do with Sierra and some other additions that Lee made. A couple of them I think are good. I've been playing with him the last couple of weeks, but he's going to do a session Thursday. I'm not inviting everyone, just people who got edge zones, so you know what to do to continue with him. I think he's going to a license key instead of, I don't know, but we'll let him explain it. Come, because he's also got a couple cool things with delta divergence and what the heck was it? A price rejector that I thought was pretty interesting. And I like that kind of stuff. But anyhow, that's Thursday. You'll get some communication on it via email. If you're in here, you'll get an email on it. So that's Thursday, probably the same time, 11 Central. The other thing that's going on is we had today, what's interesting is a gap open lower. Remember on gap open higher or lower, that if you go in the direction of the gap, or I shouldn't say that. If you gap open lower and you go down pretty quickly out of the gate, it really makes people who are long from the previous session really in trouble because they never were given a chance to get out. Well, today we gap open lower and go up, which is also important because, at some point it's a reversal for a lot of people bearish. And in the room, we weren't overly bearish, 38% versus 60 or 50% neutral. I'm just telling you, on the open, when you get a gap open lower, it's easy to trap people who are late and think, well, it's down, let's sell it. And they don't get paid and it starts to walk up. So on a gap open lower day, you got to be careful fading on the way up. I was fading on the way up, but very careful about it. Because I thought we had reached maybe a target at 72. We didn't. And then the next target way up at 70, 8 or 9. And we kind of came off of there. Point is, gap open lower, gap open higher. Find out who and overwhelmingly is thinking what and see where they're trapped. Last week, we talked about some profile stuff. Some basic profile stuff is all I want people to focus on. What is obvious to profilers? What is a setup that's popular with those individuals and those traders that just put a trade on and just think that they're going to make money on a profile setup? Where you get them stuck? A popular short for a profiler, and it doesn't work. Where does that happen? Because now you got buyers behind you. That's important from what we talked about last week, kind of what happened today. The trading room, it's not as relevant for those watching this show in the future. The other thing is the FOMC. Powell talks tomorrow, and he talks on Wednesday, tomorrow and Thursday. Tomorrow, if there's any kind of movement, will be the day, 9 a.m. Central. Thursday's just a repeat of tomorrow. It's a semi-annual testimony in front of Congress. Once in a while over my career, these testimonies have been used by chairmen to kind of, either signal policy change like Bernanke 5 or 6 years ago with that beginning of the taper of the quantitative easing. But there's sometimes some pivotal repricing moments in this testimony. Sometimes it's a chop fest, but you need to be aware of it either way. That's tomorrow 9 Central. Sometimes an hour or so before, you'll know this, there's a pretext that's released, then he gives it at 9 Central. The very least, there's a pretext released, and the news agencies drop down the wire, the bullet points, and then he gives the testimony, then it rolls into a Q&A. All tomorrow and Thursday, but tomorrow is more important because Thursday, like I said, will just be a repeat. So going into what else is driving us, U.S. and China, that trade hasn't went away forever, just temporarily, because a couple weekends ago, the whole Trump-Xi meeting put them back on the table. There will be bullish and bearish comments that come from him, from them, as that thing hasn't died. Obviously, it's a trade war till it's not, and negative or positive things could come of it. It's just a matter of time. But it's been a couple week break before or since we've heard anything, and that's normal. The other thing is, let me do this, because I think a lot of people, including myself, if you're not seeing some images on the screen, I lose your attention. All right. So U.S. China trade is still a driver. And yes, that's China. The FOMC and what Fed officials, including Powell, says their meeting is July 31st. I think July 31st and August 1. And at that meeting, they were supposed to do like a 75% chance of a 25 basis point cut. And there was actually a 25% chance of a 50 basis point cut. Friday's unemployment report, non-farm payrolls took this off the table. Now there's a 100% chance of a quarter cut. Almost 100% chance, like 99% or 97%. There's still a small chance, 6%, I think 5%, maybe a 50. But 25, because the last unemployment report the Fed's going to get was last Friday's. And the non-farm payroll number, non-farm payroll, came in way above expectations, good for the economy, good for stocks. And therefore, the Fed is less likely to do 50. Now, if it was a horrible report, a 50 basis point cut would have went up in odds. Does that make sense to everyone? If the economy is doing really good, the Fed's less likely to cut rates aggressively. One of the reasons why they cut rates is to spur economic growth, help stabilize it. One of the reasons why the Fed went from neutral to dovish in the last month or so, and why we got this tremendous rally in stocks the last month or so, was because of pending trade war concerns, the uncertainty that brought on. And so they went from hiking a quarter point in December, less than a year ago, to now being dovish and maybe cut a quarter in a few weeks. I've been trading for 20 years or following the Fed because of being in this business for nearly 20 years. I know more about the Fed and trading it than I did on the floor. But when I got a job at a prop desk, it was, I understood and learned more about Fed policy and rate cuts and everything else. I'd never seen them hike and cut the same 6-month period, 7-8 month period. Hike, cut. Maybe it was kind of close in 2007. I don't remember if they were tightening monetary policy and raising rates, and then they had to cut like crazy because of the housing market crisis. But again, it's almost like big turn of events. I've never seen it that tight. Not that they made a mistake, but maybe they did. They couldn't foresee maybe a trade war problem or whatever, what have you. You raise rates to fight inflation, and inflation really hadn't been a concern in over a decade. We had a little blip last February, 2 Februaries ago, actually, where inflation started to become a concern for a month, and we were super volatile. February of 2018. I don't know if you guys remember. So anyways, that's a little bit of where we're at right now. The drivers, FOMC, what they're going to do with rates, U.S.-China trade. To a lesser degree, Iran, make sure that hasn't gone completely away, but obviously any kind of strikes to them, against them, to us, is going to be near-term bearish. Make sure that you know the direction for that is down if there's something that surfaces on that front. I think you guys know the drivers. Here's the key with drivers, though, and that's why we meet weekly. That's why you guys meet daily, some of you guys. Drivers could change. A new driver, someone that you didn't even know, jumped into the driver's seat. That's what happened early February 2018, just for example, because I brought it up. Inflation jumped in the driver's seat. It's like, where do you come from? That's why we got so volatile for a period of a month. Then it went away. The concern, because inflation's a really problem, a real big problem for economic growth. It's a real boogeyman for the economy. Too many dollars chasing too few goods and services, and prices start to spike. Hard, fast, too high, too fast, makes things unaffordable. And the number one mandate of the Fed, if you watched my Fed webinar I did a few weeks ago, is to fight inflation, not spur economic growth. But that second mandate of spurring economic growth has become what they've done pretty much number one since I've been trading. Every time they raise rates because the economy's doing good, lower rates because the economy's not, ever since the 2001 recession. And then after 9/11, they had a surprise rate cut. All right, enough about current stuff, which is important, what we talk about, at the beginning of these meetings. But I always obviously understood adding to a loser as part of trading from the days I learned on the floor, early days in the prop firm. Some guys would do it, but they weren't allowed to do it where it was going to be a disaster. So let me start this meeting by telling people that as a prop trader, with the word accountability in your face, with a risk manager watching guys trade, you weren't going to do this to the point where you were going to put a big hole in your account or their account. You weren't going to be allowed to lose a lot. Number one, especially if you were newer. If you've never been consistent at this business, you're new. Even if you've been trying for 2 years, 3 years, 6 years, you're new. So if you're new, if you never had success, what gives you the right to trade bigger size than maybe 1 or 2 or 3 contracts? Maybe 3 contracts in the E-minis, and that's a lot. 3 micros isn't, 3 minis are. So I would tell anybody who's never had success trading, what gave you the right to trade that kind of size, number one, because in a prop firm, you never would be given 3 lots to trade. Here you go. You're new. Okay, we're going to train you. And while we're training you and while we're helping you, you're going to trade 5 lots on a real account. And then if you get into trouble and you sell 5 down there, we're going to let you sell another 5 up there. And then we're going to let you sell another 5 up there. And then another 5 up here. We're going to let you have 20 contracts on. Yeah, I know you're learning, but this is important. That never would happen. Couldn't happen because you'd be blocked out. Just like with a broker, you can only sell and buy so many with an open position, and they lock you out and say you reach your margin requirement. A prop firm has that for each individual dome. Each guy, each trader ID is given a certain amount he could trade. You're a new trader, you can only trade 2 lots. You try to click and sell 4, 5, 10, you won't be able to do it. 2 is your max size with open position. You couldn't get to 20. But if some of you guys got 10 grand, 20 grand, 50 grand in your account, they'll let you trade 20, 40, 50. Never made money trading, broke even or up a little bit, and you got 20 contracts on, you got to have holes in your head. That's why losers add to losers is not my quote. Paul Tudor Jones said it, or that's who I heard say it. I wish I would have made it up. Losers add to losers. The reason why prop firms are important to put yourself in that environment, not to go out and get hired by one, but put yourself in that environment, is because they eliminate a lot of the chances of that happening. Yeah, guys, once in a while get carried away in doing it, but he's going to be in check pretty quick that day, inside that day. He ain't going to lose too much money because the risk manager is going to tap his ass on the shoulder. Hey, take it easy, calm down. I could count on one hand how many times I added to a loser, but it never got carried away where I'm trading, let's say, 15 bonds and I got 100 on, and they're all against me. Never would. That never happened. My worst add to loser was gold on a Sunday night when it was rallying above 1,000, and I thought it was overdone because it was just the first time through 1,000, and I sold 2, and I had like 18 on. I'm like, what are you doing? It's a Sunday night overnight market. I traded back then 6 lots, 7 lots in gold, which is decent size in that market, still is today. But I had 18 on. I tripled the size on that I was used to on a Sunday night. And I never added to losers. And I ended up only being like a $2,000 loser. You know what I said? I'll get it back tomorrow. And I did for the next day or 2. So when you have a problem doing this, there's some little monkey inside your head, somewhere consciously or subconsciously, that justifies doing it. And sometimes it's because you got maybe a lot of money, or you got your other job, you can make 10 grand in a week or in a month, or you got a lot to back it up. And then that's that little greed monkey inside saying, "No, you got it. You got this. Come on." Just put another 20 in there. You got it. Just do another surgery. But the point is, you might not consciously think that, but there are monkeys inside your head that make you do this. And one of them is you hate to be wrong, and so do I. So when an adding to a loser starts, it starts with I said this in the trading, with one stupid idea to sell it. And it went against you. And then you sold more for no other reason than that average location just got a little better. That goes against you. You sell more. That little average location in here got a little better. That's the high from the drug. Doesn't last long though. You sell more, gets you a little bit better, a little closer, better location. But your ass got 20 contracts on, and you never made money for any period of 2 or 3 months in this business. And you got 20 contracts on? Holes in your head. That's not the way you got successful in anything else you did. You think that's going to get you successful in here or in this business? Now, here's where I've been ignorant to this because I started in a prop firm and because this wouldn't be a problem for anyone to the tune of losing a ton of money. Because again, they had a risk manager tap you on the shoulder, shut you down, or they manage your risk. Most guys who add to losers and get clobbered have 20 times the risk that they're used to. They're a 1 and 2 lot trader, got 20 on or 50 on because they got 25 grand in their account. You don't even have the option to do that in a prop firm because you locked out at 2. You're a 2 lot trader. You want to trade 3? Show me some good numbers and we'll bump you to 3. And you literally sign the paper. Hey, I'd go to him and I'd say, I want to get bumped to 5. And he'd say, okay, come back in an hour. Come back. He says, yeah, you're up to 5. Sign this, sign here, 5, write it up, boom, goes in your file. Then he goes to the IT guy, bump him to 5. So now your platform would allow you to trade up to 5. The point of the matter is the alcoholic is not allowed to go in the bar. In a prop firm, they take a lot of the path of least resistance that humans do right off the table. You're not going to overtrade your position because you won't be able to. You're not going to add the losers without being caught and told to settle the hell down. You're not even going to run, let alone run and hide. And so right away, when people trade on their own, you're setting yourself up for failure without knowing it. And I would say that I've been ignorant to how big of a problem this is, and that someone in the trading room answered, we've all done it. And I guess that I'm not ignorant to that. I would imagine everyone's done it if you've traded long enough. But I was ignorant to how many people have done it and lost a ton of money with it. Like way outside what they would ever make, blowing their account on that one sequence of adding. But this comment is not like, Glenn, the market always has a way of keeping you in check. It does, but you need to keep yourself in check before the market, or you're going to put a big hole in your account you might not be able to come back from. So the market does have a way of keeping you in check, has a way of bringing you to your knees and humbling you and everything else. Don't allow it by acting like a jerk. Catch the state of mind you get into as you're getting into it, where you turn 2 lots into 20 lots. Do it when you turn 2 lots into a 4 lot before you got to 20. Know what your state is and then have a plan to change your state. But it has to be identified, and there has to be a quick trigger to turn it around. You know what that change of state was in a prop firm? Simply, you don't have to go to a psychologist to learn this. The risk manager who was respected tapping you on the shoulder. Hey, take it easy. He wouldn't come out there and say, hey, you goof, what are you doing? You dumb a-hole. He wouldn't do that. Tap you on the shoulder was real professional. Hey, what's the matter? Take it easy. That's all right. You all right? And that what that did was tell you that he was concerned for your benefit, gave you the respect, but changed your state. He interrupted a pattern. And he wasn't no psychologist. You know what he was good at? Connection, relationships. So the point is, you're your own risk manager. So right off, you're going to the plate with a strike one. You're going to the plate down 0-1. You got too much money in your account, 0-2. And you were like, you go look at the umpire and say, I just walked up to the batter's box. It's 0-2, 0-2. Keep talking and I'm going to ring you up. I didn't even see a pitch. Strike three, you're out. Go sit down. You didn't get to see a pitch. So you never gave yourself a chance to see a pitch or hit a pitch because you didn't see a pitch. Because, strike one, strike two, strike three. Because you're a wise guy. So you could have 20, 30, 50,000 hours in your account. And you could, and I always tell people when they ask me what's an amount that they should have in. Sweet spot would be 20 or 30,000, but that doesn't mean that's what you risk. I always say that when they ask me how much. I always give them a number, but always tell them that's not what you're supposed to always risk, though. It's supposed to create some psychological cushion and bullets to play with. Because if you're going to risk all that, you might risk all that in one damn trade. Now, if you segregated your account, and brokers will do this for you, so you got 25,000 in there, but you segregate into an account that you're actually trading with 2,000 hours in it. So now your risk controls are a little bit better and a little bit tighter. So you take the option of adding to a loser off the table and you don't draw money from the master account that allows you the bigger leverage. It keeps you from just putting in $2,000 at a time because that gets old and psychologically beats you up. You need a cushion so you could be a little calm. But you got to thread the needle. Too big of a cushion and you get that monkey that says, you got it, put it on. Cut. The best way to eliminate a problem, first step is got to be simple. Remove them from the situation. Here's a good example. My mom told me, raising kids, she always had practical solutions. You don't want your kid that's 1.5 years old underneath the kitchen sink, and you're going to keep telling them not to do it. You're talking to a 2-year-old. Put a lock on it. Same thing with a door. Put a keyhole at the top. Done. Distract them. They're kids. You can't distract a kid. Then who's the adult? So my point is simple first. Is there a simple solution that eliminates you from putting 20 on? Yes. Segregate your account and reduce the capital in that account. And I'm talking to everybody, not just people who have had a problem with this. Everybody's probably have done it or want to do it or might do it. Everybody is susceptible to this. You'll be the most disciplined guy in the world in another job, and you come here and you're a different person, or you come into this business and you're different. You're drunk. Everybody acts different when they're drunk. Some people act a lot different and are idiots. Some people a little different, but everybody acts different one way or the other, right? So when you start gambling your own money and you feel like it's gambling and you're risking your own money, and it is gambling if you're not managing your risk, you're going to act different because you're drinking. And it's sad that people who decide to drive drunk make that decision once they're drunk. The only way to give yourself a chance not to drive drunk is to make sure you eliminated that as an option after you're drunk. You're going to make a you're supposed to make an important decision in a in a bad state of mind, right? In a mind altering state. You're supposed to make important decisions. That's great. Do you guys that are doctors get hammered before you go into surgery? You guys that are lawyers get hammered before you go into trial, or all that stuff. The point is that risking your own money is like drinking too much. And geez, I never thought I was capable of doing that. Yeah, I got pictures of you. That was you last night. So you want to be a professional. Being professional isn't not swearing or using curse words. Being professional isn't, um, you know, having a suit and tie on that it might be as a lawyer, or doctor, or, in some other businesses. Being a professional is having flip flops and socks on as you trade, but managing your effing risk, having a boss and accountability that someone tells you, slow down, stop. Anybody allowed to have 20 contracts on or any amount bigger than 3 or 4 contracts, I think is an idiot. But that doesn't mean pull 20 grand out of your account if you got 25 in there. It means make some adjustments. And I think George the Greek talked about this. Don't trade your entire account. Break it down to an amount where your risk starts to be controlled for you. But going back to losers add to losers, I always knew people did it, and I always knew it's a problem. I didn't know that everybody at some point will do it. And more people have a problem with it. It makes sense than I would have thought. And it doesn't matter if you lost 10 grand and that was your account. You're lucky you didn't have 20 in there because you'd have lost 20. If you lost 20, you're lucky you didn't have 50 in there because your ass would have lost 50. Whatever the F you had in that account, you were going to lose. And you will lose. And if you guys are doing it, getting away with it, shame on you. You're going to have your day. It's going to be ugly. And people who are better than you, that's where the money comes from. The losers that add to losers is where a lot of the money comes from. Someone's getting paid. Where's it coming from? The losers. The losers who add to losers. Anytime you have a big up day, hold on one second. Sorry about that, guys. No problem, Dan. All right, so losers add to losers. The title today, because it's well said about that. Paul Tudor Jones was it's still a trader, and he'd have him on. He'd put him on, but he was known. Here's how I'll end this. When you add to a loser, the beginning of it looks no different than any other effing trade you put on. The difference is this guy comes in front and center really quick. And if you here's a good example. If you sold 2 contracts and the market went up, 2 contracts and you got out right away, why? Because this wasn't that significant. Correct? But if you had this trade started with 8, okay, and it went up the same amount, this became significant. So you traded the trade differently because you had 8 than when you had 2, right? Why? Because 8, I hate to take a 3-tick loser with 8 because that's 8 times 3 times 1250. That's real money. Well, I could take it with a 2 because it has nothing to do with market structure, whether you had 8 or 2 on, but yet you totally traded it differently because the money mattered because you're trading too big. When the money matters, your side's too big. Period. End of story. You're not supposed to trade for the money. It's supposed to come as the reward for the experience of doing something the same over and over again, being consistent at something. And if your consistency is a strategy that sucks, at least you know that by being consistent with it. But if you're all over the map, you can't measure anything. That's where the micros are a godsend because you could have some skin in the game. You can get clobbered and not lose real money because you're not supposed to think of the money. But that's easier said than done. As soon as I say don't think about the money, you're thinking about it. So I can't say that and expect you to be able to problem solve through it. But what I can tell you is the only way you could put yourself in a position not to think about the money, because at some point we're going to think about the money. That's what we're doing it for. But if you put yourself in the best position not to think about the money, it's to have the appropriate size on. So getting out of a loser is no big deal. If getting out of a loser, you start thinking of the money, you're not going to get out of the loser. You might even sell more and more and more and more. So it all starts out from one stupid trade that looked like all the other trades and winners you might have had. Only this one didn't work. So now it's not looking like the other ones. And you're trading it with more and more size because it's all about the money. You lost all kinds of control. And now you're making decisions as to whether or not to drive when you're hammered. Good luck. I know what the decision's going to be. You're going to take a shot. I'm not driving that far. I got it. I ain't going to call Uber. And then I got to come back, pick up my car. Crazy. That's a pain in the ass. And you're going to drive. And you might get away with it. And you might get away with it. You might get away with it. But the time you don't get away with it, it costs you $5,000 or God forbid you kill someone or yourself. Big risk, small reward. That's what adding the losers do. Eventually, you do it enough, you're going to get clipped. Hopefully, you don't kill anyone, but you're going to get clipped. Adding the losers, you're going to get clipped. And you do it because you're making the decision as you're drunk. Make it beforehand. What's the beforehand? Trading too goddamn big. And that's what you'd be told. Don't take offense to using God's name in vain. Too bad. You're in a prop firm. You're going to take a lot of offense to some bad words. Professionally talk. That's how you get talked to professionally. Trading too big. And you're your own risk manager, zero discipline. So the point that I'm trying to make is find the solutions before it becomes a problem. Find the solutions if it's a problem. Find solutions if you think it might be a problem. But make sure you find solutions because it is the path of least resistance as you're getting going. You're not trading big size to make money. You're trading big size because you qualified to trade big size. You bumped your size. Have a workout buddy, a trading buddy, and anything else. Do the coaching sessions that I offer. I couldn't say this 6 months. I should have been doing these things right along. I get, I don't do too many where I don't look forward to the session because that's not fair to the guy or to me. But there are great results of being able to bounce something off someone in real time that saves you money in the long run. Doesn't have to be me, but you got to have coaching. Michael Jordan had a coach. You got to have a workout buddy in this business that says, "Are you stupid?" Because they want you to get better, not because they hate you, right? That's one of my old sayings. You need someone to tell you that you suck because they love you and they want you to get better, not because they hate you and they want to put you down. You need the you suck partner, not to beat you up, make you feel like crap, actually make you feel good. So the whole don't trade the money doesn't work because as soon as you say that, you're thinking of it. But what you trade the money is because you're trading too big. As soon as you start thinking money, you're trading too big. Yes, there have been people that have done the coaching session in the first round and the second round. Um, if someone were to ask me, how do I put this? If someone were to say to me, um, "You flooded with people that want to do it," no, but I should be. I talked to a guy who did coaching session, and he was flooded with people, and he couldn't do 1/10 of a session that I could do. People piss money away to the market and losers, and then they worry about much smaller amounts of money that truly invest in their well-being. A few $1,000s is not a lot of money. It's nothing. It's cost me 7+ figures to learn to trade and have that accountability in a prop firm. So you need coaching. You need people never allow you to do stupid stuff. Take it. Hey, the way I could draw this final analogy is when you have good trading partners or good accountability or the right discipline, it's someone taking your keys before you started drinking. It's not even driving to the bar. Could you drive home? Not an option. Could I have 20 on adding? Not an option. And if you've lost a lot of money, which most people probably have, adding to losers, you're lucky you didn't have double in the account or triple or quadruple, or you'd have lost that too. So drop down your money into small segregated accounts and trade those and worry about the experience and the rewards come. But experience only comes when you're consistent. And you could be consistent and making money without stop and still be learning, being coached. You think that professional athletes, they're contributing as they're learning. So never stop learning. Get some accountability with some coaching. Make sure this is not a problem. Take the bad choices right as options, and they no longer become a choice. This is not a bigger problem than I thought, but a problem, more consistent problem than I thought with people that come into this business and they don't know any better, right? And you end up doing it. They don't even know this uh, adding to loser phrase. I thought it's averaging. You could average, but that better be your damn plan before you get into trade. Don't mix up adding to averaging. That's what they justify. I'm averaging. Was that a detailed plan before you put on the first package? Well, no. Well, then you're full of shit. So I hope this session helped. It was kind of an impromptu session. I didn't plan on doing it. Maybe it should be the first one at the beginning of this course, though. Have a safe week. Trading room guys, we'll see you tomorrow. The rest, we'll see you next week. Thursday, if you get an email, and you most likely will if you're in here, we're going to do a Thursday session at 11. But it'll be more of a tutorial on Sierra.